That is the only mandate of the Fed: price stability and full employment. And let's be clear, right now we don't have price stability.
But above all else, we must defend to the hilt our economic interests.
We don't want to be dependent on the supplies coming from foreign countries. That's the key point.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Paris for the OECD conference, where the Secretary of State, Antony Blinken, is also here. Now, here's what's coming up on today's program. Facebook suffers a devastating outage across its most popular platforms. Mark Zuckerberg's personal fortune plunges by $6 billion. Ken Griffin has a message to the young: you are making a grave mistake by working from home. The CITADEL chief executive spoke to Bloomberg. And an exclusive interview as the energy crisis worsens. We speak to the former BP chief executive, John Browne. If you have any questions, just IB plus TV Go. Now let's get straight to our top story. It's definitely the markets after the rout we saw yesterday. Not only some of the tech stocks, but overall a worry about inflation, of course, overall worry about what kind of growth we'll be left with. So let's get straight to Danny Berger in London. Hi, Danny.
Hi, Francine. Look, we did open up on these European equity markets higher. Futures were higher, but we're having a difficult time really sustaining any significant gains. You're looking at an S&P 500 future session, which is flat. It's unched, no change. And then you have some dip buying when it comes to NASDAQ futures. But Francine, really the pain has been in longer duration. So in these big tech type things. So we're not getting dip buying. It's not enough to really get people in, be it higher rates. That's the concern, regulation, so on. But you are seeing some dollar bid buying there. And Brent also moving higher beyond $81 a barrel. Now, this all comes to this concern about prices. How acute is this price rise going to be? If it is a lot, if we are seeing rates moving higher, it stands to reason you don't want that big tech. And this regime change idea really is captured very well by James Bullard, who yesterday, the St. Louis Fed president, talked about a changing mentality from corporations, saying he's concerned about it and the relative freedom that businesses feel they can just pass on in terms of increased costs easily to their customers willing to pay it as well. So if that is the environment we're in, if Bullard is happy to raise rates soon, what happens in this market? You sell tech. Of course, the FANGs, about 20% of the S&P 500 index, taking a bath yesterday. So that really affecting the entirety of the market. And Francine, we're really struggling to make up for those losses this morning.
Yes, we look at high valuations. We also look at high yield in China. Danny, another Chinese developer, of course, falling into crisis on Monday after failing to repay a nearly $206 million bond. Now, Fantasia is adding to the strains of the nation's heavily leveraged property firms following industry giants Evergrande's debt troubles. So let's get the latest on Fantasia with Bloomberg's Rebecca Chung-Wilkins, who joins us. Rebecca, thank you for being with us this morning. Quite a lot going on, of course, in China. What are we seeing, or how are we seeing stress manifest across China's credit market today?
Well, we're seeing a pretty savage sell-off in China high-yield debt this morning and later coming into the afternoon session. Bonds on average down about 5 cents on the dollar. Those single B weaker rated names down as much as 10 cents. And I think, you know, the real concern here is after sort of Fantasia took the markets by surprise with this default, although it was known that it was sort of having some issues with its financial health, the real worry is that the kind of refinancing risks for property firms become unmanageable, and it becomes a self-fulfilling prophecy where borrowing costs soar and kind of weaker firms are unable to tap the offshore bond markets to kind of roll over all of this masses of offshore and dollar debt that they need to repay this year and through the next 6 months. And that, of course, the worry is that will lead to more defaults, and defaults we've already seen leading the kind of record wave of corporate bond defaults in China's corporate bond market so far this year.
Rebecca, thank you so much. Rebecca Chung-Wilkins there for us on some of the high-yield credit that we're seeing in China under pressure. Now, Facebook's Mark Zuckerberg has apologized for a global services outage that kept its social media apps offline for much of Monday. Now, for more on the story, Bloomberg's Laura Wright joins us. So I think we'll get to Laura actually in a second. A couple of connection problems between Paris and London. I don't know whether it bodes well or not for foreign relations, but we'll get plenty more, of course, on Facebook shortly. Yesterday, the outage lasted about 7-8 hours. I know we'll break it down. Of course, we'll also see what Facebook is doing to stop avoiding that. It's 24 hours after we heard from the whistleblower. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. So coming up, we'll look at the markets, we'll look at the energy crisis deepening. A little bit later on, we speak exclusively to the former BP chief executive, John Brown. You can send any questions you want to IB plus TV Go, or you can also tweet me directly at Flacqua. This is Bloomberg.
We don't trade crypto because of the regulatory uncertainty. We often make markets in companies whose business models I don't really have fondness for, because one of our jobs as a market maker is to meet the liquidity demands of American families that want to invest in X, Y, or Z. And frankly, it's not my job to tell them if they're right or wrong. It's my job to provide them with the best possible price. Because of the lack of regulatory certainty around cryptocurrency, we just aren't involved today. And I really believe that Chairperson Gensler is spot on the need to have thoughtful regulation around cryptocurrency. I actually think that doing so will make it a smaller market, because it'll become a far more competitive market when there's regulatory clarity. And that will be good. A smaller market, less people involved who are frankly just trying to make a quick buck, and whatever the virtues are of that product, and I think those are pretty nebulous, will become very different in a world of competitive exchanges and competitive pricing by tier one market makers willing to put their best foot forward. So I really believe that Chairperson Gensler is spot on the need for regulation, and the SEC has got a solid history of writing good regulatory policy.
To be clear, though, if it were regulated, you would trade it?
I would trade it because it would meet the needs of our online brokerage partners who want to have a tier one firm making prices. I mean, part of the reason that we are so significant in retail market making is our incredibly high reliability. We're there every day and every minute of every day. And we provide a great service every day and every minute of every day. And they want us to provide pricing in crypto. I just don't want to take on the regulatory risk in this regulatory void that some of my contemporaries are willing to take on. If you are early in your career, you are making a grave mistake not being back at work. It's incredibly difficult to have the managerial experiences and the interpersonal experiences that you need to have to take your career forward in a work remotely environment. Work remotely is very good at maintaining the status quo, but the world's not static. Competitive pressures from around the world will put American businesses continually under pressure. The Chinese have been back at work literally from almost the start. They're continuing to evolve at a very rapid rate of innovation. And we are, in many ways, stuck in patterns from 18 months ago because it is so much harder to create and to innovate in a remote working environment. So for our youngest members of our workforce, I'm gravely concerned that the loss of early career development opportunities is going to cost us dearly over the decades to come.
The founder there and chief executive of Citadel, Ken Griffin, giving his thoughts on crypto and working from home. I have to say it was a 1-hour conversation with our Eric Schatzker. It was a good conversation, and Mr. Griffin had opinions on everything. Now we're joined by Edmund Shing, Chief Investment Officer of BNP Paribas Wealth Management. Ed, great to speak to you as always. I have a million questions on tech valuations. I have a million questions on crypto and actually what happens to the markets. Are we heading towards a pretty severe correction, especially in tech stocks?
Well, hello, Francine, first of all, of course, and welcome to Paris. What I would say is that this has been somewhat overdue, in my view. We also have to bear in mind that September and often October, September is certainly the weakest seasonal month of the year for equities historically, and October is somewhat volatile as well. So a correction is unsurprising. What is perhaps more surprising is we haven't had a correction so far this year. It's been almost, if you draw any chart on your Bloomberg terminal of equity indices, it's pretty much bottom left, top right in a straight line. That's very unusual. We haven't had any corrections of 4% until now. Now maybe you've got a correction of 5, 6%. Okay, a little bit more in the tech heavyweights, but let's not forget that comes against the backdrop of fantastic gains in those tech mega caps over the last couple of years. So, I mean, it's really been quite an extraordinary ride. And really, to see a small drop now, I think we should not exaggerate and say, is this going to turn into a bigger correction? Of course, it's always possible. But for me, when I look at the underpinnings of equities, you say earnings are going the right way. Earnings forecasts are still going up and quite sharply. And secondly, real long-term real yields in the bond market remain very solidly negative. And there's no sign that central banks are going to change that anytime soon.
So what are we worried about? There's quite a lot of high-yield credit things in China that we could worry about. So a spillover effect. It's very clear that developers are under pressure. Could it actually infect the rest of the market in the West and elsewhere?
Of course, because Chinese economic growth, were it to collapse, would clearly have a huge impact on global economic growth. And therefore, we all, you know, it's in the old days, we used to say if the US sneezed, Europe caught a cold. Well, I think that's probably more true of China these days, that if China has a hiccup, we all suffer to some extent. Now, is that going to happen? Are the Chinese Communist Party and the Chinese administration going to allow contagion in financial markets to spread from Evergrande into, for instance, the residential property market? I think they're going to do everything they can to prevent that. They will, I also believe, attempt to force an orderly restructuring of Evergrande so that we don't have this spillover effect into Chinese residential property markets, because that is hugely important to the Chinese economy. So they can't afford it, basically. And we live with uncertainty, but the equity markets and markets in financial markets always live with uncertainty. That's why we call it climbing the wall of worry more often than not. And I think that's where we are today.
And when you look at some of the biggest valuations out there, what do you buy at the moment? So there's still the energy crisis that's looming. We could see, of course, a lot more pressure on some of the margins, which is why we're seeing quite a lot of analysts actually also repricing some of their earnings expectations. What do you buy right now?
Well, I think the biggest story out there is the commodity story, because let's not forget that if you were to look at the Bloomberg Commodity Index, until relatively recently, it was a pretty sorry state of affairs. It was a pretty ugly chart. I mean, you've put the one-year chart up there, which looks fantastic. If you were to put the 10-year chart in there from 2011, it would look almost the mirror opposite of what you see there. It would be top left, bottom right. It would be a tale of woe. Now, we're just recovering from that. So we've had one good year after 9 or 10 pretty poor years for commodities. And I think there is more ahead. I think inflation will be more persistent for longer. Commodity prices, risks staying high for longer. Now, OPEC Plus, with their announcement yesterday, were very clever in that they clearly boosted oil prices. But the question is, Francine, when we talk about stagflation, remember, what is stagflation? It is the point at which these persistently high prices cause demand destruction. Now, is Brent at $81 a barrel going to do that? The answer probably at the moment is no, but they can't go that much higher, because when we get into the hundreds, then you really do risk demand destruction, and that's something that the OPEC Plus nations do not want at all.
Ed, thanks so much. Edmund Shing, their Chief Investment Officer of BNP Paribas Wealth Management, stays with us. Now, let's get straight to Facebook with the very latest of what happened yesterday. Here's Laura Wright. Hi, Laura.
Well, perhaps you felt some panic yesterday, Francine. Roger Hearing on radio compared it to living in the 70s. A network configuration at Facebook led to a global outage, impacting 2.7 billion users of Facebook Messenger, Instagram, WhatsApp. It was down for around 6 hours. Even Facebook's internal systems were affected. Engineers had to be on site to physically reset those servers to get things going again. Many users flocked to alternative messaging platforms such as Signal, which is non-profit, profit. That saw millions of new downloads yesterday. So what did this mean for Facebook's stock price? Well, it was under pressure even before news of the outages became apparent. That's because a former employee turned whistleblower gave an interview on Sunday evening pertaining to Facebook's privacy policy. But once the outages made the headlines, Facebook closed down 4.8%, and that led to a broader tech sell-off, with the Nasdaq closing down over 2%, Francine.
Laura, thank you so much. Laura right there with the very latest on Facebook. So let's get back to Edmund Shin. Ed, are you buying any Facebook at the moment after the huge sell-off yesterday, or does it just look too risky? I don't know whether regulation and breakup is back on the cards.
Well, yeah, I have a moral objection to Facebook. I really don't like the company. I don't like its product. I mean, WhatsApp is an incredible product, as is Instagram, but I really don't like them because I do think there is a huge moral issue about young people and about our children, and about the fact that they become addicted to these apps. And that really worries me, particularly with Instagram. And what I think the Facebook outage has shown us is just how much we do rely on things like WhatsApp. I mean, my wife was pulling her hair out yesterday because, you know, I have kids in London, I'm sitting in Paris, we were trying to contact our kids. We always use WhatsApp to do that because it's so convenient. And yet, guess what? Yesterday, my wife couldn't figure out why it suddenly wasn't working.
I know.
Right? But you're right, it's interesting. So we did use Signal, so, you know, but I think it will give people a wake-up call as to how much we rely on this necessary infrastructure and how much Facebook sits behind all of this. And maybe people will continue to look for alternatives to try to diversify.
On morality, is there any other industry group that you're shunning?
There are always plenty. But I have to say, technology is the one, internet stocks is the one that worries me the most. But what I would say is that while we as a bank, the Green Bank, push very much an ESG and a sustainability agenda, we are going through a very rapid energy transformation. And I would say that you cannot ignore energy stocks. I would be a buyer of energy stocks because I think oil and gas is not going to disappear. We are not going to go to a zero reliance on fossil fuels in the next few years. You only have to look at the explosion in natural gas and coal prices to tell you that. And we have not developed enough infrastructure for storing electricity, battery storage or other forms of storage to be able to store the wind and solar energy so that when the wind doesn't blow, the sun doesn't shine, we still have electricity because unfortunately, users still want electricity 24 hours a day. So we need to put that infrastructure in place. It's going to be a huge investment. I think that's a huge opportunity for us. And it's something I think in Europe, we're going to grab with both hands, hopefully with the EU Recovery Fund behind us.
Ed, do you buy into cryptos at all? Or do your clients ask you about crypto?
All the time. I think.
And they don't ask?
For me, the issues are, I think I do have to agree with Ken Griffin. There are issues about some of the actors in the space as to their, how much you can trust them, and I'm not sure you can. I think there's a lot of shady operators still in the space, and as for us as wealth managers, that is a clear concern. Regulation needs to be put in place, and I think central banks and governments have been very clear that they want to put that in place. And I think the longer-term question is going to be the race towards central bank digital currencies, those so-called stable coins. Are these going to really challenge Bitcoin, Ethereum, and the other cryptos? I think there's a really good chance that they will in many areas, that people will find those attractive alternatives. And then the question is, what is the raison d'etre of Ethereum and Bitcoin in a world where you have these digital currencies provided by central banks, giving you that flexibility and ease of use that you currently get from the cryptos?
Ed, thank you so much for all of your insight. Edmund Shin, their Chief Investment Officer of BNP Paribas Wealth Management. Now, coming up, we'll talk a lot more, of course, about energy. Smart conversations continue on Bloomberg Surveillance Early Edition as the energy crisis deepens. Later this hour, we also speak exclusively to the former BP Chief Executive John Browne, Lord Browne. Send in your questions on IB Plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Paris. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. OPEC Plus is sticking with its plan for a slow and steady increase in oil production. Ministers from the group ratified a 400,000 barrel day hike for November, but due to the global energy crunch, many market watchers were expecting a bigger boost in output. That's pushed crude to the highest since 2014. The Federal Reserve's internal watchdog plans to probe trading activity by senior U.S. central bank officials. It follows revelations about transactions last year that forced regional chiefs Kaplan and Rosengren to resign. Last month, Chair JPMORGAN opened an internal investigation into the central bank's ethics rules. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, coming up, we'll discuss green investments with John Browne, the chairman of BEYONDNETZERO. There's a new $4 billion climate fund by General Atlantic. This is Bloomberg. Facebook suffers a devastating outage across its most popular platforms. Mark Zuckerberg's personal fortune plunges by $6 billion. Oil rallies to its highest since 2014. OPEC Plus maintains gradual supply increases despite the energy crunch. And an exclusive conversation as the energy crisis worsens. We speak to the former BP chief executive, John Browne. If you have any questions for him or the team, IB Plus TV Go. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Paris for the OECD conference. Well, we'll also be speaking to the Secretary of State, Antony Blinken. Now, let's talk about energy, the crisis, and of course renewables. We're joined by John Browne, Lord Browne. Between 1995 and 2007, he was the chief executive of BP. Currently, he's the chair of BEYONDNETZERO, a $4 billion new climate fund from General Atlantic, where he also serves as senior advisor. Lord Browne, thank you so much for joining us on Bloomberg Surveillance Early Edition, where we spend quite a lot of time trying to figure out the energy transition, what it means for energy crises going forward. What do you see, Lord Browne, as this prescription today for governments to make sure that we don't end up with more energy crises and energy concerns like we've had in the last couple of weeks?
So I think the rules really haven't changed, that you need diversity of supply and you always need a little bit of a cushion, because one thing about energy is you just can't turn it off and not suffer enormous consequences both to human beings and to industry and to markets. So it's more diversity. And I think we need to remember that while we're in an energy transition, it is a transition. And so we will still need hydrocarbons for quite a long time, as well as other sources of energy. And what we've got to do is we've got to figure out how to decarbonize some of the hydrocarbons in order to meet the net zero targets that are so important to meet by 2050.
But Lord Browne, if you look at the IEA and that important report, it basically says that we need to stop using any kind of fossil fuel if we're going to meet those targets that we set out in Paris. So how does it work? We have energy prices at the moment at a record high. We have oil prices also quite high, hurting growth, but it's very difficult to use some of these fossil fuels. What's the right balance?
So we still need to use fossil fuels. We haven't finished the transition. And it's important, therefore, that we maintain supplies that we need at the appropriate level. So you can see natural gas is really tight, both in the United States as a result of a lack of drilling in the shale basins and the lack of associated gas. So Henry Hub is up there. Gas prices in the United Kingdom here are enormously high as a result of demand around the world and a lack of supply. Many people diagnose that as Russian supplies falling short. Actually, Russian supplies are higher than they were certainly a year ago, and that is not the only reason for this. So a lot of demand. We still need hydrocarbons in order to satisfy the net zero targets, we have to do things like CCS, carbon capture and storage, decarbonizing hydrocarbons, as well as dramatically increasing other sources of energy, such as renewables, which clearly are very competitive with fossil fuel prices, as well as nuclear, which is something which I think the debate is around now, a positive debate, that we need to get some more nuclear into our system.
But so, Lord Browne, first of all, if you continue using fossil fuel as you transition, how long does it delay the transition by?
So I think it depends on how you use the fossil fuels. We have to decarbonize them. So you take natural gas and you use it to make electricity, but in so doing, you capture the carbon dioxide and either bury it or use it for something else. That is what you need to do. And so it is very important to decarbonize hydrocarbons while we're using them over, let's say, a 20-year period. There are plenty of other sources of energy. They need to be increased dramatically. After all, we need to invest enormously into infrastructure to do that. I think the latest estimates are $3.5 trillion a year. We're investing, let's say, about a third of that at the moment. So we need to increase our investment levels to a very high level here.
What's the right way of managing some of these emissions? And how do you avoid actually greenwashing or miscalculating, scope 1, 2, and 3? So what's the right way of doing it so that we make a real difference instead of just putting labels that don't mean anything?
So the most important thing is to make sure that we try to get the low-hanging fruit. First, we've got to make sure no methane escapes from human activity into the atmosphere. Methane, which is natural gas, is probably 100 times more damaging than carbon dioxide, and we need to lock that up. We can measure that from space. We can see what's happening. We need to make sure that nobody emits unnecessarily methane, point one. Point two, we need to make sure that we keep increasing investment, and we keep thinking about different technologies to use hydrocarbons in a carbon-free way. We can't turn them off yet. It would be very nice if we could, but we can't. But we have to do that in a very sensible way. We've got to, in order to get to net zero by 2050 and 1.5 degree temperature rise, which is an ambition we should still hold, we have to get rid of half our carbon dioxide in the next 10 years. That means we need to move very quickly, decarbonize everything we do, keep efficiency rising, keep adding more and more non-fossil fuel to the electricity pool.
So, Lord Browne, how do you see the role of private capital in tackling climate change? And can you talk a little bit about Beyond Net Zero? Why now?
Well, Beyond Net Zero is part of General Atlantic. General Atlantic is a tremendously successful and experienced growth equity fund. And we've concluded that as part of General Atlantic, it's important to invest horizontally in the growth of activities in different sectors that reduce carbon dioxide, whether that is better control systems to distribute electricity in an effective way, to control industrial processes, to reduce the amount of energy they use, to change the way we think about farming, for example, to invest in things like vertical farms, and to decarbonize hydrocarbons with carbon capture and storage, or, for example, converting natural gas into hydrogen without emitting any carbon dioxide, and using that hydrogen as a clean fuel around the world. So there are plenty of things to do, and this is the right moment to do it.
Where do you see the most opportunities? There are some investors that say actually the right way is to invest in clean tech further down the line rather than buy a green ETF right now.
Well, I think I would always say invest in proper businesses and make sure they grow, and that's important, to grow them to the level that they begin to move the needle. And there are, right now, 80% of the technologies we need over the next decade to really make inroads into carbon dioxide are available to us now. So it's a matter of investing them, making great businesses, and investing them directly. I think the most important thing for everyone to do is to set proper targets here. We have these big macro targets set by governments, but every company needs to set targets probably in line, which I believe in, the science-based targets, which are independent targets set for each sector, and actually track year by year, not over 30 years, but year by year, last 5 years, 10 years, what you're actually doing. That stops people saying they're doing something and not doing it, so-called greenwashing. So investing in companies and not greenwashing.
Right, and on the greenwashing, what should asset managers do actually to avoid greenwashing, given we don't have the same labels for everything across the world?
Sure. But I think they should start by demanding targets for each company, targets which are set independently, and targets which the performance against which is verified independently. That, I think, stops people simply signaling virtue, but actually signaling real performance, a bit like financial performance. People expect targets to be set, to be met quarter by quarter, and that's the sign of a good company. I think the same is true with emissions of carbon dioxide equivalents. It's set targets, measure them, probably not quarter by quarter, but year by year, against 5 and 10-year targets, and then explain what you're doing. And that, I think, is the hallmark of a great company. And indeed, in General Atlantic and Beyond Net Zero, that is what we want to do as we make investments with General Atlantic.
Lord Browne, how's fundraising going?
This is part of General Atlantic. So General Atlantic has a very large fund, and that's where we are at the moment.
Fabulous. Thank you so much for a very interesting conversation and your insights. Lord John Browne, the chairman of Beyond Net Zero, senior advisor to General Atlantic, and of course, former BP chief executive. Coming up, President Biden warns that the U.S. may breach its debt limit, blaming the Republicans for the meteor headed towards the economy. We'll get the latest next. This is Bloomberg.
The Republicans in Congress, what they're doing today is so reckless and dangerous in my view. As soon as this week, your savings in your pocketbook could be directly impacted by this Republican stunt.
Well, President Biden there offered no guarantees on whether the U.S. would avoid exceeding its debt ceiling within the next 2 weeks. He says it's up to Mitch McConnell planning the Senate, blaming the Senate Majority Leader for a so-called meteor headed for the economy. Well, joining us now is Bloomberg's Bruce Einhorn. Bruce, thank you for joining us. Always talking about U.S. politics. So the issue seems very urgent. How urgent is it?
Treasury Secretary Janet Yellen has said the government will run out of cash by around October 18th. Other observers say there may be an extra week or two, but either way, by the end of the month, the cash will be gone, according to most experts. So something's going to need to happen. Chuck Schumer, the Democratic leader in the Senate, is planning on a vote on a bill that has already passed the House that would suspend the debt ceiling until the end of next year. The Republicans have already blocked 2 versions of that earlier, and Mitch McConnell has said that they will not approve this one.
Right, so what happens next? Is there a timeline of how you see events unfolding?
That is a good question. So what does happen next? So McConnell wants the Democrats to solve all this through reconciliation. That's the budgetary procedure that doesn't involve the filibuster. The Democrats could do it with 50 votes plus Vice President Harris breaking the tie. The problem is that that's a lengthy process. It could take several weeks. And it's complicated. The Democrats are saying, no, we're not going to do it that way. So we'll have to see who blinks first. Meanwhile, we've got President Biden, who seems quite frustrated about this and is pointing out, because he wants everybody to know that this is something that the Republicans have an obligation to help, he says, because they ran up about $8 trillion in debt during the Trump years, so that accounts for about a quarter of the total U.S. debt. So it's the president is saying you approved the spending, so now you have to approve the lifting of the debt ceiling in order to actually pay for it.
Bruce, thanks so much. Bruce Einhorn there, looking at all the intricacy of the debt ceiling and, of course, what we'll see in the next couple of hours, maybe days or weeks. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Garrett. Hi, Leanne.
Hi.
Actually, I think we'll get back to Leanne very shortly. We'll look at the markets. Of course, a lot going on in the tech sector. Yesterday, we saw a sell-off in the U.S. It's all about inflation. And then we'll have also a look at what we're seeing in high-yield credit in the U.S. Coming up, we'll have plenty more in China. We'll have plenty more on FANTASIA and Evergrande. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Paris. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. Chipmaker GLOBALFOUNDRIES has filed for an IPO. It's looking to capitalize on the chip boom amid a severe shortage of semiconductors. The firm is owned by the investment arm of the Abu Dhabi government called Mubadala. Bloomberg previously reported it was looking to value the business at around $30 billion. Another Chinese developer has fallen in crisis after failing to repay a maturing bond worth over $200 million. The problems at FANTASIA are adding to the strains facing the nation's heavily leveraged property firms. FANTASIA poses fewer risks to the broader markets than Evergrande, which is facing what could be one of China's biggest restructurings. JPMORGAN is banning business travel and in-person meetings for employees who aren't vaccinated. It also says the unvaccinated will face higher payroll deductions to cover the cost of testing and health insurance. Wall Street banks have been adjusting their rules as they continue their push to bring staff back to the office. And veteran hedge fund manager Ken Griffin has a warning for younger employees. You're risking possible career advancement by continuing to work remotely. The CITADEL chief says working outside the office also hinders innovation. He thinks working from home could cost us dearly over the next few decades. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, this is what we're looking at. Activist fund engine number one has taken a stake in GM. The chief executive, Jennifer Grancio, said GM chief executive officer Mary Barra is making excellent decisions and that the company is on the right track. While Grancio spoke with Bloomberg's Romain Bostic, Caroline Hyde, and Shanali Bazak.
GM and Exxon are two very different cases for us. So at engine number one, we believe that companies have to look at their material impacts and take that into account because impacts are linked to long-term economic value. So in the case of General Motors, we think Mary and the board and the leadership team at GM is doing exactly the right thing. And so this is a position for us where the company is making excellent decisions about how to understand impacts, change that's coming from a climate perspective, and is looking to scale a battery and electric business to actually take advantage of being a leader on the other side of the change. So a very different scenario, and we think GM is on the right track.
Jennifer, is GM the only one on the right track? It's interesting that you take sort of an incumbent and a company that's pivoted entirely, a legacy business almost, rather than, say, Tesla, which is the one that, well, some other key females in the ETF sector have always loved, or indeed Ford's doing its own. Do you think that you'll broaden your viewpoint on some of the other key auto companies?
Yeah, our point of view is that there's huge value in these incumbent companies changing the way they do business. And so if we take Tesla, for example, they have been on battery and electric. That's their core business. But from a manufacturing perspective, they make a certain number of cars a year. Then let's take General Motors. General Motors has for a long time been doing research in this area. So they have a lot of intellectual property, and they've been making investments and will make more investments in real scale around battery technology. So GM makes 9 million cars a year. And when they make a transition to totally electric, they're having a huge scale impact. So to your question, yes, we look at companies that are already big incumbents. But when they get it right and they can figure out how to drive these innovations to scale, we think there's huge value. And in the incumbent space, some of the companies that do that first probably will gain the most from a market share gain perspective over time.
I'm curious about what you think about GM overall. And do you share any concerns about GM, particularly with some of the missteps we've seen with the Bolt EV battery and recall?
Yeah, I mean, our perspective is that innovation takes time, and GM has been invested in learning in this space for a lot of years. And so, in a sense, who better to have learned from things that have happened so far? Who better to scale this technology going forward?
Engine number 1 Chief Executive Jennifer Grancio speaking there to Bloomberg's Romain Bostic, Caroline Hyde, and Shonali Bazik. Now let's take a look at some of the things that we'll be watching out for today. Later this morning, 10 a.m. UK time, we'll have some Euro area data, including PPI. EU finance ministers are also in Luxembourg for the Union's Economic and Financial Affairs Council. Proceedings kick off at 11 a.m. UK time. We'll also have some data today from the U.S. beginning at 1:30 p.m. UK time, including trade balance as well as services PMI. Now, at 3 p.m. UK time, the OECD 2021 Ministerial Council meeting starts. The two-day event will be chaired by the U.S. I'll be actually moderating a conference, a panel on the Blue Dot Network, talking about U.S., its rivals, and of course what it can do with China as well. Anthony Blinken, the U.S. Secretary of State, will be joining me. This is what the markets are looking at now. We are seeing a rout in technology stocks that's easing somewhat. If you look at the contracts on the NASDAQ 100 index, rising now some 0.4% after the underlying index plunged to the lowest level since June yesterday. I'm looking at COM. More calm in global markets, being shattered by a growing wall of worry spanning a debt in China, but also spanning elevated inflation on the back of this commodity supply shock and also fading economic recovery. The U.S. political bickering is still at the forefront. If you look at the turbulence, it comes even as investors brace for tapering of stimulus by the Federal Reserve. While Bloomberg Surveillance Early Edition continues in the next hour, I'll be joined by Danny Berger in London, Katie Lyons in New York. Again, we have a full roundup of everything we've seen from the markets to energy crisis, to some of the high yield credit that we're also seeing in China. This is Bloomberg.
That is the only mandate of the Fed, price stability and full employment. And let's be clear, right now we don't have price stability.
The fourth quarter is going to be very tough. Big picture, still optimistic. Business cycle is set to be a good one.
I think the near term is a little more treacherous, but we don't have the signs of a recession. Unless we have a recession, it's hard to see a big down move in the market. So I think we're going to tread water with a lot of volatility in both directions.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lyons.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, October 5th. Our top stories today. Facebook finds fault. The social network blames the huge outage on a change in its network configuration. President Biden does his own blaming. He warns the U.S. could breach the debt ceiling in 2 weeks, says it's the fault of Republican Senate leader Mitch McConnell. Another Chinese developer has fallen into crisis. This time it's Fantasia, which failed to repay a $206 million bond that was due. I'm Danny Berger in London alongside Francine Lacqua in Paris and Kaylee Lyons in New York. Matt Miller is off this week. And Francine, you are so missed in the London studio, but you have a really exciting schedule ahead of you in the OECD forum there in Paris, speaking to Secretary Anthony Blinken as well.
Yes, of course, it's U.S. foreign policy, left, right, and center after Emmanuel Macron took it extremely badly. That, of course, they were snubbed on the submarine deal. So this is, I guess, the U.S. chance to make amends or to explain their strategy with allies, including with or without China. And that, of course, will filter through market movement.
Right. And of course, in terms of trying to make amends, Kaylee, is it a turnaround Tuesday after a pretty ugly session yesterday?
Maybe that's the case in Europe and the U.S., Danny, but it certainly was not the case in Asia. Of course, Chinese stock markets are still closed for the holiday, but we had down days a lot of other places, including in South Korea and Japan, where stocks fell around 2% each. Actually, the Kospi falling into a technical correction, and the Nikkei 225 in Japan is just a few tenths of a percent away from falling into one. You did see some resilience for Hong Kong stocks, though. The Hang Seng up about 0.25%, though property stocks within that index did fall. Of course, it's not just Evergrande we have to worry about now, but Fantasia missing that bond payment yesterday. The contagion is spreading, and that is really putting pressure on Asian dollar bonds, which had their biggest drop for high-yield bonds going all the way back to 2013. Also in foreign exchange, I would point out the Kiwi, the big underperformer in G10 today, weaker against the dollar by about 0.1% ahead of the RBNZ policy decision tomorrow. As for the picture here in the U.S., as Danny alluded to, it was a deeply negative day for stocks yesterday. Actually, the S&P 500 falling to its lowest level since July. The NASDAQ 100, its lowest level since June. But we are seeing signs of a rebound this morning, though a tentative one. Right now, S&P futures are up about 0.3%. Steady as she goes in the bond market. That may be helping risk sentiment today. The 10-year yield sitting right around 148.76. The dollar is stronger on the day, maybe getting a little bit of a remaining haven bid. And then I would just point to oil at its highest since 2014. Danny, OPEC Plus sticking with its plan, 400,000 barrels a day production hike in November, not giving into temptation, even though oil prices are around the highest in years, Danny.
Well, certainly some of those higher oil prices is helping the energy sector. Of course, we have a lot of the oil majors listed in London. You can see the FTSE 100 up 0.5%. But generally, we're seeing a stronger market here in Europe, snapping 3 days of losses. This is a pretty orderly gain, given that more worse session when it came to the Asian session, which Kaylee, you highlighted. Usually you'll have Europe pick up a tinge of that negativity, especially because China cracking down rather on luxury space, making a lot of speculation around there. Doesn't seem to really be hurting France too much. This is up 0.6%. Really, the leader, though, in today's market is Italy. We're looking at a FTSE MIB up 0.9%. Let's switch up the board so I can show you why it is that Italy is gaining so much. And it's because the bottom of the board here, it's a stock 600 banks. This is the best performing sector so far today. That's up 1.6%. Italy dominated by the banks in the region. So this is a story of trying to contain some of the fallout when it comes to higher inflation, higher rates. You buy banks as a hedge of that. Now, in terms of that higher inflation, higher rate story, you can see natural gas on the top here. It's that energy crisis not giving up. The price of natural gas in Europe skyrocketing yet again today, up 13%, crossing the threshold of 100 euros at its highest price on record at 109 euros and some change. Germany break-evens also at another record, only up about 3 basis points, but still moving higher beyond 1.74. Finally, some weakness in the euro dollar. This really is a falling yield play. However, of course, stronger king dollar certainly helping push down the euro as well this morning, Francine.
Yeah, Danny, I love the fact that you actually looked at European banks. I think there was a note by JPMORGAN this morning saying that they will benefit, of course, from dividends now that they can pay it out. They will benefit from rising bond yields and possible re-rating. Now, this is what is going on ahead today. First of all, Tokyo hosting the TCFD summit to discuss climate-related financial disclosures. Now, the Bank of Japan Governor Haruhiko Kuroda is amongst the speakers. Also, European finance ministers meet in Luxembourg amid the worst energy crisis that the bloc has seen in years. The OECD 2021 Ministerial Council meeting starts today. Speakers include the Secretary General, Matthias Cormann, and the U.S. Secretary of State, Antony Blinken. This is why I'm in Paris. And then Microsoft Windows 11 and Office 2021 launches. Now, this comes as the company's shares have come under pressure this month. Onto the energy crisis and, of course, the tech crisis. Facebook's Mark Zuckerberg has apologized for a global services outage that kept its social media apps offline for much of Monday. We've never seen anything like it. The world was in meltdown. Let's get the latest with Bloomberg's Laura Wright. Laura, could this happen again?
Hi, Francine. Well, it was a network configuration which led to a global outage of Facebook's key platforms, Facebook, Messenger, Instagram, WhatsApp, affecting 2.7 billion users. Now, as you mentioned, Mark Zuckerberg was led to apologize. Engineers actually had to go on site to the servers to physically reset them. Now, many users flocked to alternative platforms such as Signal, which is non-profit. A key proponent of that is Twitter's CEO, Jack Dorsey. But it raises concerns about dependency on one platform.
Yeah, absolutely. And I really struggled with nothing to check all afternoon yesterday. Laura, it would be great if this was Facebook's only problem, but it's not. There is a whistleblower from the company who is testifying on Capitol Hill today about it prioritizing profit over people. Just how consequential could that testimony be?
Very, Kaylee. Well, Frances Haugen gave an interview to CBS 60 Minutes on Sunday evening. Now, when Facebook opened yesterday, it was actually that interview which put pressure on the stock and meant it was already trading down over 4% before the outages were announced. As you can see in pre-market trading, Facebook up 1.6% right now, demonstrating some recovery. But Haugen will be speaking to a Senate subcommittee later today about privacy, about the frightening truth behind Facebook's opaque management structures. So definitely worth keeping an eye whether there'll be more downside for Facebook later today.
Yeah, and if there's any more regulation coming down the pike. Thank you so much to Bloomberg's Laura Wright. Now heading over to Washington, in a speech from the White House yesterday, President Biden demanded that Republicans stop blocking Democratic efforts to suspend the debt ceiling, a legislative battle that's brought the U.S. government to the brink of its first ever default.
The Republicans in Congress, what they're doing today is so reckless and dangerous in my view. As soon as this week, your savings and your pocketbook could be directly impacted by this Republican stunt.
Anne-Marie Horder, Bloomberg Washington correspondent, joins us now from D.C. So, Anne-Marie, Chuck Schumer says he's going to put a debt ceiling lift to vote in the Senate this week. Republicans have promised to shoot it down. If it fails, what is the course forward in terms of getting the debt ceiling lifted before the Treasury runs out of money?
It's a great question. Senator Schumer yesterday invoked cloture in the Senate. This was the House-passed bill on the debt ceiling, but he needs 60 votes. And how are you going to get 10 Republicans when you have Senator Mitch McConnell writing a letter to the president saying the Republicans will not go alongside you on this? The Democrats need to do it alone, and we've told you for weeks you need to do it alone. So what's going to happen next is someone has to blink. Either there needs to be enough Republicans to come on board and allow this to go through. You would need all the Republican senators to at least agree to allow a simple majority vote to go through, and that's very, very unlikely. So then the Democrats are going to have to try to go through this via reconciliation, the same path they are using for their $3.5 trillion spending package. They're going to have to do that to raise the debt ceiling. The issue is experts say that takes about 2 weeks. Now, we're now 13 days away. So if they're going to do that, they need to move very quickly.
I was going to ask you, Anne-Marie, in terms of timelines, what kind of timeline are we looking at? Is it, 2 weeks and the meteor hits, as the president has called it, the economy?
The issue with the debt ceiling is you don't know exactly when it will all stop and turn off in terms on defaulting on the debt. Treasury Secretary Janet Yellen has marked out that the Treasury deems this day to be October 18th. But even in that letter she wrote to congressional leadership, she said it can move forward or backwards. So we are getting very close to the quote-unquote brink of defaulting on our debt, which Moody's Analytics has said could be catastrophic, not just to the U.S. financial market, to the global financial system, but also millions of jobs. A mini recession can incur on this, all while we're still dealing with a pandemic. So the timeline for the Democrats, though, Francine, to answer your point a bit more directly, to use reconciliation would be they would need to begin it today, within this week. And what also is a little bit uncomfortable leading up to the debt ceiling is that the House is out of session for 2 weeks and the Senate is off next week as well. So this is a really crucial week in Washington.
Right, of course, perhaps markets waiting till closer until that deadline to have any sort of reaction here. Anne-Marie, thanks so much. That's our Bloomberg's Anne-Marie Horder. Now, another Chinese developer is falling into crisis. Fantasia failed to repay a nearly $206 million bond, adding to the strains of the nation's heavily leveraged property firms. Bloomberg's Tom McKenzie joins us now. So, Tom, first Evergrande, now Fantasia. Does this suggest that the stress in the property sector in China is spreading?
It is spreading. I mean, this is clearly evidence of it. Fantasia is a much smaller company. That is the caveat in terms of its liabilities. You're talking about $13 billion US versus $300 billion for Evergrande. So that's the context. It's number 60 in terms of contracted sales versus number 2 for Evergrande. But absolutely, this is partly as a result of that contagion. We've seen the yields on those offshore dollar bond notes for these property developers spiking well above 15%. And of course, the regulations put in place started last year by the Chinese government to try and rein in the borrowing of some of these highly levered companies. So that is the context. Whether or not, of course, they're able to secure the spread is what's going to be in focus, and where we are in terms of the restructuring, if it comes, for Evergrande as well. And the question mark for investors is how much hidden debt as well, because I talked about the $13 billion of liabilities for Fantasia, the appropriately named property developer there, and $300 billion for Evergrande. It's the stuff that's hidden that is a concern as well for investors.
Well, Tom, China isn't just dealing with a property sector crisis, it's dealing with a power crunch as well. And China has ordered banks to prioritize funding to boost coal output. How does that run counter to China's environmental goals?
Well, that's a really good point, and it's exactly why you've seen an energy crunch, not just because of those regulations, also, of course, energy prices globally rising, but it didn't help, essentially, that China was putting in place curbs earlier in the year to try and meet those carbon emission goals. Even if those are admirable, it's left to this energy crunch, particularly in the northeast and southeast of the country. You've seen most regions having to cut back. That led to what we saw in terms of that manufacturing PMI, the first contraction for factories for China since the pandemic. You've seen downgrades for the outlook for growth as a result of that from the likes of Goldman Sachs and Nomura. Now, as you say, officials leaning on the bank saying, look, you've got to spend more, or at least lend more, I should say, to those energy companies, to those coal companies, so they can up production to ease some of these energy constraints. So that pressure remains. The banks having to juggle their contagion or their exposure to the property sector, and now being asked as well to support the energy sector amid these very, very high energy prices.
And being told they can't use lending to speculate in commodities. Thank you so much to Bloomberg's Tom McKenzie. Let's bring it back to the U.S. now and take a look at some stocks moving in pre-market trading. And of course, we talked about the outages Facebook was dealing with, but Twitter had some of their own reported yesterday, and the stock fell nearly 6% as a result. Some people, though, may be taking advantage of that dip to come back in and buy. The shares up about 1% in pre-market trading this morning. Another upside mover is OPEC, the biotech company. This is on reports, the company saying that it has reached an agreement with CanSino to use one of its gene therapies for an eye disease. Plus, it also has reached a supply agreement on a COVID-19 vaccine. So that stock is up about 7% before the bell. One mover to the downside, though, is Albertsons, the grocery company. It got cut to underweight at BMO with a $26 price target. That's well below the $30 a share it closed at yesterday. This morning, it's trading right around 29, down about 3.3% before the bell, Francine.
Kaylee, thank you so much. Now we'll have plenty more, of course, on the markets. We'll look at this wall of worry, including what we're seeing with inflation, high-yield credit in China, and, of course, global GDP. Coming up, a conversation with Laurence Boone, the OECD chief economist. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix in Paris, Danny Berger in London, Kelly Lyons in New York. Now let's get straight to the market and, of course, to the economy. The OECD 2021 Ministerial Council meeting kicks off today. It's the organization's highest level forum, attended by ministers of finance, economy, foreign affairs, and trade. Well, joining us now from the conference is Laurence Boone, chief economist at the OECD. Laurence, great to speak to you. You've always been a great student of inflation. You've, of course, warned on some of the debt out there and the prescription for Europe to move forward. When you look at the wall of worries in the markets right now, it's China, high yield, the concern that actually could be a Lehman moment, and then everything that we have to do with inflation. What's your top one worry right now?
So thank you, Francine, for the invitation and for being here for the Ministerial with us. One of our biggest concern is obviously inflation after the health crisis. Also, we would urge to actually look at the various factors explaining what's going on. We do project inflation will continue rising for a few months, but that it should start taming off. And that's for a few reasons. The first one is one of the things driving inflation, as you were saying, it's shipping cost, and that's some disruptions that stay with us from the virus. So that should go as the health situation improve. Other thing is we're seeing some wage growth in some sector, but they're usually hotel, restaurants, and sectors where low qualified, low paid people were high proportion, and it's actually quite good that they're seeing their wage rising. And you were mentioning earlier on energy prices. This is part of an adjustment, right? It's a one-off in prices. That doesn't mean that they will continue to rise forever.
But Laurence, so is there a danger that actually central banks are doing a policy mistake by continuing, believing and telling the markets that inflation is transitory?
So the central banks have the toughest job of all at the moment because they must distinguish between what's temporary, what's more structural. Obviously, I think temporary, when we talk about the disruption from the virus, it can be 12 months or 18 months. What's super important at this stage is actually to make sure that we are seeing some shift in wages where it's needed. But we're not seeing this wage price spiral where people get scared because some prices are rising. They ask for wage increases. Firms saying that then push up their prices. Then people ask even more wage increases. That's the type of spiral that we really don't want to see. And for this, I think it's super important that central bank clarify how and when, under what condition they will act to keep inflation expectation anchor and avoid this type of slippage.
Laurence, it's Kaylee in New York. I want to pick back up on the energy crisis, which you mentioned. Even if prices don't stay this high forever, could they stay high for long enough that it means you have to reevaluate your growth forecasts?
So if I knew that, I would probably be very rich and on the market. But more seriously, I think what we're seeing is effectively some shortages, and that creates price increases. It doesn't mean that they will last throughout. But I think what's important to take away from this, it's really what's happening with energy transition, because there's been a lot of talk about it. We're seeing how energy prices are moving. Now we must address the fact that we need to shift from carbon energy towards decarbonized energy sources. And that's going to take a change in the price and quantity of what we're consuming. So today it's oil and gas, and we need to move away towards more renewable towards more renewable energy, and that will help prices tame down.
Well, we know that China was trying to prioritize more renewable energy sources and has now told coal producers to ramp it up because of the power shortage that they are dealing with there. And that's not the only issue in China. You also have a broader economic slowdown, some crisis in the property sector. How worried are you about the potential ripple effects from China to the rest of the world?
So as you know, so that's a really good question. As you know, China has contributed to about a third of the global economic growth, which is very significant. So we cannot ignore what's happening in China at all. Now, when we look at, for example, the property market, we at the OECD, like other international organizations, have actually warned that, when the growth engine is too much residential investment, it is not sustainable. And Chinese authorities have been trying to move away from this type of investments and to encourage consumption in China. So that's not happening. They need a better social security system to encourage consumption. And obviously the housing market will slow. I would about to say, it has to be a soft landing. It has to be cleaner of credit risk. It's usually bumpy soft landing, but we are confident the authorities have the fiscal and monetary space to actually manage it and avoid too much spillover outside of China. But yeah, this is definitely something to watch.
Well, Laurence, when you have this dynamic in China, you have other idiosyncratic issues with other nations, be it their pace of recovery from COVID, be it the energy crisis. How far away are we from seeing any sort of synchronized global growth?
So we had this synchronized global rebound, right? And when you look at it, for the world, we've nearly wiped out the effect of the crisis on GDP. That's a very remarkable achievement. But I really like your question, because to have this sort of synchronized global growth, you actually need discussion between the global power. You need coordination of their economic policies. And that is very much what we're trying to do here at the OECD, and that this Ministerial Council is pushing forward, including on digital taxation, including on climate, and including on how to coordinate a stronger and more sustainable recovery.
Laurence, we're getting quite a lot of questions from viewers asking about how governments should deal with the debt they've amassed during the pandemic. Do they need to look at financial repression, austerity, or just surrender their budget to central banks?
So it's true, we've seen a massive jump, as you said, in public debt. Now, there's one thing I would like to, we would really like to convey today, which is that, there is no magic number for debt sustainability, right? Japan has been living for a very long time with 200% of GDP debt. But conversely, some emerging market economies may run into default and into solvency issue with 35% of GDP debt. What I think is very important, and what we're working on at the moment, is to ensure that both spending and taxes are not only sustainable, but directed at priorities and endorsed by their democratic people. And the sustainability, the faith that it reflects people's choice, it's taking into account long-term issues like aging, and that there's a strategy which is transparent behind it, that is endorsed by investors. That is what makes a debt sustainable. What we've said is, support your economy during the crisis. Now that we're getting out of it, it's the time to better target the spending, and also not to engage into excess spending in a structural way that would put debt into danger.
Laurence, thank you so much for your time. As always, Laurence Boone there, Chief Economist at the OECD, talking to us about a range of things, including, of course, the debt, how you deal with China, and everything in between. Now let's get straight to the Bloomberg First Word News, and we start with JPMORGAN Chase rolling out new measures to prevent coronavirus infections. Now, the bank has banned business travel and in-person meetings with employees who have not been vaccinated or won't disclose whether they've had their shots. Unvaccinated employees also will face higher payroll deductions to cover the cost of testing and health insurance. Now, in Manhattan, apartment sales soared in the third quarter to their best showing in decades. Closed sales totaled more than 4,500, well, according to appraiser Miller Samuel and broker Douglas Elliman Real Estate. That's the most for any quarter dating back to 1989. Buyers are acting fast and paying more as last year's COVID discounts have gone away. Now, coming up, Freddie Late, founder and chief investment officer of Latitude Investments, a conversation on markets. I'll leave you in the capable hands of Kaylee and Danny as I'm going over to the OECD for a conversation with the Secretary of State, Antony Blinken, a conversation that will be on China and, of course, how he also deals with its allies, including France. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Kaylee Lyons in New York. Matt Miller's off this week, and Kaylee, Francine has just left us for a cracking panel at the OECD conference. Anthony Blinken will be part of it. But in the meantime, we just had that fascinating conversation with Laurence BROWNE of the OECD, who says inflation risks in her mind are going to start to tail off.
Yeah, it seems that the market may be buying more the whole inflation is transitory kind of thesis, but that doesn't mean that we're seeing really robust risk sentiment. Yes, we are seeing some buying of yesterday's dip coming in, Danny, but it isn't the strongest dip buying we have ever seen. Stocks are in positive territory in Europe to the tune of about 0.6%, so they have recovered yesterday's losses. It's really banks and technology leading the way in Europe, and of course it was technology that was the big underperformer here in the U.S. yesterday. The NASDAQ 100 falling more than 2% to its lowest level since June. But this morning, it is actually big tech futures that are outperforming the most. NASDAQ 100 futures up about 0.5%. Probably helped out by the fact that yields aren't moving materially higher this morning. We're up less than a basis point on the U.S. 10-year yield, sitting at 148.59. And I would point to the commodity spot index as well, the Bloomberg commodity spot index at a record high. On the one hand, you have oil at the highest since 2014. You also have surging natural gas prices because of the energy crisis, and of course, just higher demand for raw materials in general. Now, with that move higher in commodities, specifically oil, you are starting to see energy outperforming in pre-market trading once again. The likes of Devon Energy, Marathon Oil, each up between 1 and 1.5%. And then, of course, the other story of yesterday was the outages at Facebook and the whistleblower testifying on Capitol Hill today. Facebook fell about 5% yesterday, but some buying of the dip coming in this morning, up about 1.5%. Twitter had outages of its own, also fell 6% yesterday, but once again, shares in positive territory in early hours, Danny, up a little more than 1 percentage point.
All right, I can't get off of this tech theme because it was such a consequential move yesterday. So I want to stick on it, perhaps look into some of the technicals. I want to welcome our radio listeners as well. I have a chart in front of me that I will explain to you as well. It is a very simple line graph of the NYSE FANG Plus index. So this has all of the usual suspects of FANG plus NVIDIA, the other large cap tech. And I also on here have its 200-day moving average. And I have them both here really just to emphasize the degree of the fall in tech yesterday. We nudged right up to that 200-day moving average with about a 3% decline in this NYSE FANG index. The last time we saw it fall below was in March of 2020. So this really reflecting a lot of the carnage we saw during the beginning of the pandemic. Of course, this picture is really consequential for the entirety of the benchmark itself. This is about 20% of the S&P 500. And if these didn't even exist in the S&P 500, the main equity U.S. benchmark would have halved its losses. So what do? Will this continue to fall further? Will there be any dip buying? Well, let's get to our next guest who knows a thing or two about big cap tech. It is Freddie Late, CIO and founder at Latitude Investment. Freddie, first off, thanks so much for joining. So in both your Horizon and your global fund, you own Alphabet and Facebook within the top 10. So were you a buyer on this dip yesterday?
Good morning. Yes, I think we have been a buyer on this dip, and I do believe that Facebook's trading at an incredibly attractive valuation, as is Alphabet. Both very interesting shares to own, and I think you can own both within a diversified portfolio. Obviously, Facebook yesterday suffered from bad headlines, the outage, the whistleblower around some of the social concerns, which I believe they're addressing head on, and also from a sector and style rotation. You know, as interest rates have been rising, we've seen the kind of long duration big cap tech getting hit. And I think while there's a lot of overvalued stocks in that kind of environment, stocks like these are actually very well priced given the growth they should generate for clients. So we're happy buyers at these levels, yeah.
But these aren't the only mega cap tech stocks. And as you say, many of them are much more richly valued. Can you be bullish the equity market if you think some of those other more richly valued names may underperform in a higher rate environment?
I think it's quite tricky to be bullish on the overall equity market if you think there's an environment where those large cap tech stocks and the broader long duration, high quality growth, defensive growth stocks are likely to fall over, because it's probable that's an environment of interest rates expectations rising, at least if not rates themselves, tapering, and maybe some inflation being a bit more stubbornly persistent than expected. In that environment, I think overall valuations are likely to fall as well as some of the more richly valued tech stock. And I think it's very difficult to see the market marching higher in that environment. And that is probably what I expect, along with harder earnings growth and GDP growth indeed next year. So I think we are entering quite a difficult phase for the market, and it's tough to see it going up without that tech leadership.
So does that mean it's time to pull back on equity exposure and readjust your asset allocation, Freddie?
Well, it's a really hard question because stocks are still more attractive than bonds at the current level of bond yields, especially on a real yield basis. You will make a real positive return from a long-term holding in a portfolio of equities at this level, whereas you won't if you buy and hold a conventional government bond. So I think you'd need to see an actual move higher in interest rates to drive the relative value back towards bonds. And I think it needs to be a few hundred basis points of move. So I think you've got a cushion to owning equities for the long term, but I just think if you're thinking shorter term about it, I imagine the next quarter is going to be pretty choppy and with far more risk to the downside, unless we see a reversal of the central bank policy, sorry.
Sure, no, totally fine. So a few hundred basis points, I mean, that is a obviously pretty large move when it comes to treasuries, but could we see something like that? How much further do yields have to go in terms of their upward trajectory?
Yeah, I think at the moment, if we're talking for the next sort of 6 to 18 months, I think it's going to be far more about the speed with which interest rates move than the level. I'm not suggesting interest rates are going to hit 3.5% anytime soon. Or that's yields, 10-year yields. Interest rates, certainly not. But I do believe the speed with which they move will have a major impact on the sort of factors and styles within the market, and therefore, to your earlier question, the market level overall. The faster we see a move higher in interest rates, even if in the US they go to 1.75 or maybe up towards 2 on the 10-year, I think if that happened rapidly in the next, say, 6 weeks, we could see a meaningful pullback in the market of 10, 15%. I mean, let's not forget this move we saw yesterday took the cumulative fall in the S&P to just over 5%, the first fall of that magnitude this year. Yeah. It's been a very, very easy run so far, and it would be a huge surprise to expect more volatility.
Yeah, definitely good context to put in there, Freddie. And of course, that move higher, the pace of which has already affected equity markets. One thing, though, that has confounded many is that high yield spreads have remained so thin. Why haven't we seen some of the concerns spill over into that risk market?
Well, at the moment, the reason why we're seeing inflation, which is what's driving rates higher, is a demand pull. All of the government stimulus on the fiscal side has really driven, stronger consumer balance sheets, stronger corporate balance sheets, and this extraordinary demand coming through a supply chain where there's a huge amount of friction. And so in that environment, it's a positive economic environment. You wouldn't expect to see high yield sort of risk premia going higher. It's not that we're pricing in a massive slowdown or recession next year. It's sort of the opposite, that the party may be coming to an end because inflation and rates and tapering all have to happen, because economic growth is reasonably strong, in fact, very strong. So yeah. I think that's why you haven't seen high yield spreads moving higher yet. And I don't anticipate they will unless we see a contraction in economic activity.
Freddie, we're only about a week away from earnings season. It's really quite hard to believe. And you have the likes of Morgan Stanley warning that earnings may not surprise to the upside to the degree we've seen over the last year or so due to a lot of the supply chain pressures that are out there. As we head into this earnings season, how concerned are you about profit margins?
Reasonably concerned at an index level, and certainly for some of our individual names as well, although we believe they can ride through it. I think, with ROEs and profit margins at record highs in the US market in particular, but around the world more broadly, and I'm not surprised Morgan Stanley is saying we can't beat earnings as much as we have in the past 6 to 9 months, because it's been extraordinary, the level to which all companies across all sectors and regions have been beating earnings and really pulling through very, very strong numbers. I think you are likely to see a slowdown in the top line, an increase in the cost of goods sold, an increase in the wage line, and probably a little bit more pressure for potentially around taxes and subsidies and furlough schemes rolling over. The offset would be one-off COVID costs going away, but it won't be enough to stop that squeeze on margins. And so I do believe you'll have less operating leverage, more cost inflation, and it's unlikely to see what you need, which is higher pricing at the revenue line coming through for another 6 to 12 months. So I do think you'll see a lot more misses, a lot more downside volatility, and generally supply chains really being the feature this earnings season.
Supply side problems seem to be everywhere. Thank you so much for your valuable insight this morning. That's Freddie Late, CIO and founder at Latitude Investment. And coming up, speaking of supply issues, the transition to clean energy may be a cause of decades of crises like the ones we are seeing now. More on that from our big take next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later on today, U.S. Council of Economic Advisors member Heather Boushey. That's on Balance of Power at 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg.
What we're seeing is effectively some shortages, and that creates price increases. It doesn't mean that they will last throughout, but I think what's important to take away from this, it's really, you know, what's happening with energy transition, because there's been a lot of talk about it. We're seeing how energy prices are moving. Now we must address the fact that we need to shift from carbon energy towards decarbonized energy sources.
OECD Chief Economist Laurence Bon speaking to us earlier. Let's stick with the energy and the energy crisis story. The world is living through its first major energy crisis of the clean power transition. The next several decades could see more periods of energy-driven inflation, fuel shortages, and lost economic growth as electricity supplies are left vulnerable to shocks. It's our big take today. You can access it by going NI Big Take on your terminal. Let's dig more into this. Joining us now is Todd Gillespie, Bloomberg's Power and Renewables reporter. Todd, thanks so much for joining us. So first off, the question on the top of everyone's minds as we see the energy crisis unfold: how much longer does this have to run?
Oh, well, that's the question that everyone really wants to know the answer to right now. But really, I mean, this is a volatile story for the entire energy transition, quite possibly. And it really just kind of underlines the urgency for governments to go towards backup sources of energy which are more stable, more reliable, make sure that our renewable energy mix is also kind of linked in with ideas about storage, making sure that we can plan ahead and not just rely totally on imports and, you know, all sorts of energy, which is also very dependent on all sorts of international flows and other countries' geopolitics as well.
Right. So then does this mean that this speeds up the transition to those more sustainable types of energy sources?
Well, that's the question that we should be asking governments right now. Boris Johnson is talking a lot about investing in hydrogen and nuclear in the UK in particular, wanting to sort of electrify all sources by 2035, or at least go towards non-carbon types of energy. I mean, we're looking at sort of removing our dependence from natural gas in particular, right? I mean, this is kind of one of the big marks, which is, you know, when you don't have energy systems that are so volatile, so dependent on such a volatile source of energy, then you can sort of start talking about a more stable energy system, a more predictable energy system, and one that doesn't constantly feed back worries to consumers and to private companies as well.
Obviously, there has been a lot of investment recently, Todd, in renewable energy, in sources like solar and wind. And a lot of people have said that has led to just straight up underinvestment in legacy energy sources. How do we strike that balance going forward so that this doesn't happen again?
Yeah, that's right. I mean, Jeff Curry from Goldman Sachs was saying that the other day on Bloomberg. It's a controversial point, to be quite frank. I mean, there are some people who very much buy this thesis that sort of the old economy has been underinvested in. We've moved too fast towards investing in renewables and haven't really thought enough about stability during that transition. It's perhaps a fair point, but it also kind of underscores the urgency of actually, you know, going faster and actually going faster towards more renewable sources in a more sustainable way, because frankly, you know, this is going to cost money, but it's going to cost even more money in the long run if we don't do it, and we don't do it faster because of the impact from climate change and from all of these carbon-intensive energy sources.
What's the biggest barrier to doing it faster and to scaling up some of these renewable energy sources?
Batteries are one of those things. Hydrogen development as well. A lot of these things are still in their infancy. Places like Australia and California are still already sort of rolling out battery technology to try and store solar and wind sources overnight. But you know, some of these things only last for 4 hours, so you need you need a lot of coordination with the grid and different types of sources. So the science is really kind of being invested in heavily right now, but obviously it's not as reliable, and it's not you know, we don't know enough about it relative to what we know about coal and gas that we've been using for decades. So that sort of, sort of attention needs to be taken right now.
It's a brave new world. Thank you so much to Bloomberg's Todd Gillespie. You can, of course, find his big take story on the Bloomberg terminal and online. And coming up throughout the day, the Bloomberg Invest Global Conference will focus on the key issues driving institutional investment strategies. We'll hear from Grayscale CEO Michael Sonnenschein, Brookfield CEO Bruce Flatt, and Soros Fund Management CEO Don Fitzpatrick. This is Bloomberg.
If you are early in your career, you are making a grave mistake not being back at work. It's incredibly difficult to have the managerial experiences and the interpersonal experiences that you need to have to take your career forward in a work remotely environment. Work remotely is very good at maintaining the status quo, but the world's not static. Competitive pressures from around the world will put American businesses continually under pressure. The Chinese have been back at work literally from almost the start. They're continuing to evolve at a very rapid rate of innovation. And we are, in many ways, stuck in patterns from 18 months ago because it is so much harder to create and to innovate in a remote working environment. So for our youngest members of our workforce, I'm gravely concerned that the loss of early career development opportunities is going to cost us dearly over the decades to come.
Citadel founder and CEO Ken Griffin speaking with Bloomberg's Eric Schatzker yesterday. And joining us now is Tom Keene, co-anchor of Bloomberg Surveillance, who is in the office. He has been in the office. Tom, when was the last time you worked from home?
I worked from home. It was really difficult. Technically, it was a great joy. And I won't mince words, Kaylee, as you well know as well. Bloomberg management has killed themselves to make it safe and effortless. I really can't tell you the luxury treatment, folks, we've had from day one. We did that, Kaylee, with, oil a little lower. We are beginning to migrate higher, and it gets your attention. Francine looks at Brent crude, 81.62. Let's go to what really matters, which is a gallon of gas. And let's go to the facts, not the angst that's out there. The pink line is the moving average that matters. That's your paycheck moving average. We have launched higher. We have launched out of the last 4 or 5 years on the edge of getting back to the angst that we saw of an average of $3.58 a gallon, somewhat up near that $4 level.
Tom, how do the pros in the equity space use this in terms of their inputs for asset allocations and earnings estimates?
It's really, really important question. Commodities trend better. That's the Commodities 101, Danny. They always trend better. So if you find the trend and take it over to your equity belief, maybe you can do better than good. I've had personal good experience with that. You've got to get in the trend. And the arch question now is a breakout in commodities. Looking at the Bloomberg Commodity Index, is that trend sustainable? And we're, of course, as you know, we're hearing from major houses they believe it is.
Yeah, Bank of America calling for $100 oil in the near future. Tom, obviously gas prices have been in part driven by the fact that we're seeing an energy crisis in many parts of the world, including the UK, Europe, China. We were speaking with Laurence Boone of the OECD earlier, and she said it's not going to last forever, so kind of look through it.
Well, I'm a huge fan of Laurence Boone's work. I knew her back at, I think it was Merrill Lynch years ago. And Dr. Boone and the others are looking at the supply and the supply and the demand dynamics. And their belief is the supply challenges will go away. You call it an energy crisis. Is it an energy crisis or is it a supply crisis? Kaylee, an energy crisis is when your father buys a VW diesel that when you're on the expressway really can't get going and the guy in the BMW drives over you.
Nah,
that was the 70s.
My dad drives a 68 GTO. Forget a Beetle. Anyway, Tom Keene, co-anchor of Bloomberg
That was our
Surveillance.
lust car in high school.
Tom Keene, co-anchor of Bloomberg Surveillance, talking cars and all things gasoline with us this morning. Thank you so much. And now let's take a look at what else we're watching. And I am watching the economic data. We get ISM services for the month of September at 10 a.m., Danny. And what's really going to be interesting is because, of course, this comes just days before that crucial September payrolls report. So will it show a slowing because of issues on the labor side? Obviously, there are shortages, not just of energy, but of people. There's a real labor shortage out there. That results in higher pressure on the wage front. So what kind of impact will that have on activity in the services sector? That's what I'm really interested in this morning.
It is such a busy day for data. I have to say we got some PMIs out here in Europe as well. They didn't move the needle at all. Hopefully there's a little bit more excitement, maybe more optimism in those U.S. figures. Well, Kaylee, I am looking forward to Francine's panel that she gives at 1 p.m. Paris time, about 7 a.m. New York time, if I'm not mistaken. It is called High-Level Panel on Catalyzing Quality Infrastructure Investment to Build Back Better. Yes, that is a mouthful. She has a lot of interesting guests here, but the most interesting one, perhaps, is Secretary of State Antony Blinken. So a lot she's going to be able to discuss there, whether it comes to ESG, this idea of building back better, which I should say, of course, is a refrain we've heard the Biden administration use, and recently some tweets from Boris Johnson of him eating fish and chips and bread and butter. I don't think I'm British enough to understand what that is about, Kaylee.
Yeah, I'm nowhere near British enough for that, Danny. But it's interesting. I'm sure Francine will have some excellent questions for Secretary Blinken on foreign policy and geopolitics, but on building back better in infrastructure, we have to keep attention on domestic politics as well, because of course there is an ongoing debate about the future of President Biden's Build Back Better agenda and the trillions of dollars in economic spending he would like to see passed. There's that question and the debt ceiling question, and it's unclear if Senate Republicans are going to blink and allow the debt ceiling legislation Chuck Schumer is going to put to the floor in the Senate this week to sail through. And does that raise the risk of a default that the market is not yet appreciating, Danny?
Yeah, I would also say in terms of the debt ceiling, keep your eye on the demand for some of this short-term paper that, of course, would be breached or would be in trouble if we did breach the debt ceiling. Demand there, Kaylee, has indeed been slowing.
Yeah, and of course, you can track that on the Bloomberg terminal. More Bloomberg surveillance is ahead. We'll hear from Dr. Amish Adalja of Johns Hopkins, among others, including Megan Green of the Kroll Institute. This is Bloomberg.